Hello and welcome to Your Money Matters. I am Angela Jarrell and I've got Ted Bauman and Clint Lee with me. Hello, gentlemen.
Well,
So I hope you are a subscriber to our YouTube channel. If not, click that button below because we've been talking these last Your Money Matters about hedging strategies against volatility. And sure enough, here we are. We record these on Fridays and what a volatile week it has been. Just today, the payroll was a huge miss. We've got the Federal Reserve suddenly hawkish. And I hate to say it, but there's still a pandemic out there that likes to wreak havoc on the stock market every so often. So I'm seeing these comparisons now about how the current market looks a lot like it did before the dot-com bubble burst. And essentially what that means is we're seeing that the Dow is ending up one day, the Nasdaq down, vice versa. It's not moving in sync. And it's just another sign of an unhealthy market. So Ted, what I'd like to know, what everybody watching would like to know, is this the beginning of the end, or is this just another great opportunity to buy the dip?
well, it's not the beginning of the end because the stock market never ends. Okay. I mean, I think that's the most important thing to remember is no matter what happens, the thing is just you've got strategy and you've got tactics. Strategy is you're trying to make money. Tactics is you need to be intentional about it. And that means sometimes you need to pay attention to what the market is telling you and adjust your portfolios accordingly. And right now, I think what the market is telling us is that the era of super high valuations, where investors are prepared to ignore these insane multiples of 10 or 20 times forward sales and all that is maybe coming to an end because it depends on the artificial fuel from the Fed. So let's quickly look at a couple of things that are going on. The first thing I want to show you is the 5-year Treasury yield, and I've taken this back over a 10-year period because I specifically wanted to point out that aside from that big spike in 2017, 2018, 2019, the 5-year yields were pretty stable during the mid 2000 or mid teens, I guess. And we're probably heading back up to that kind of a level. And if you recall, it wasn't really until sort of late 2019 or kind of mid 2019 and into the pandemic when a lot of these growth stocks took off like a rocket. You remember that just before the COVID crash, stocks had reached new heights. There's clearly a relationship between these kind of midterm treasury yields and the appetite or the willingness of people to pay for future earnings. So if we're heading back up towards that level, in other words, the kind of levels that we saw back in those days, which is around the kind of the 1.6 yield on the 5-year, then basically we could be back to that sort of scenario, and that's really important for investors to be aware of because you just don't want to buy into stocks at high valuations if that's where we're headed. The second thing I want to show you is just how absurd things are looking, particularly in the Nasdaq. This is the Nasdaq Composite, which obviously contains a lot of firms, not just the big ones, but some smaller ones too. The top panel shows PE ratios since the beginning of the year. They just keep marching higher. Second panel shows price to sales, and I've put this over a longer term because I just wanted to illustrate that they started to drift higher around 2014, and then they've really taken off this year. So even though there's been a slow upward drift of price to sales, they've gone ballistic this year. Next panel is price to book, which is another critical measure, same pattern. There's been a slow upward drift, but the rate of change has gone up. And then finally, price to free cash flow, which is my personal favorite because I like companies that earn cash because cash lets you do things. Look at 2021. I mean, it spiked, fell back, and then it started to tick back up again. So bottom line here is that, where the big tech companies and the small tech companies reside, i.e. the Nasdaq, we're seeing that multiples are historically stretched. So that's the one thing. But here's the second thing, and this is even more important. Multiple expansion is one way that stock prices go up, right? People are willing to pay more for future earnings. But if you have a situation where people have kind of bet that earnings are going to go up by willing to pay higher multiples and then they go down, you're setting yourself up for a pretty brutal correction unless the Fed comes back and rescues the market again. And I think they've said they're not going to do that. So here's a chart that shows forward estimated earnings growth for selected sectors for next year. And I've highlighted the ones that are, really set up for the most brutality. One is financials, and I think that's probably because you'd think that with rising interest rates that banks and whatnot could get higher spreads on their loans and whatnot. But I think it's also because of concerns about credit yields, particularly high yield, junk bonds and all that. So there's a lot of nervousness there. But the key one is technology and communication services, which is where a lot of these high-flying, high-valued companies are. And we're essentially, the market is pricing in almost, or the estimates have halved since the beginning of this year. I mean, in April, people were thinking that in communication, you'd get 17.6%, earnings growth next year. Now it's down to 6.9. Overall, the estimations have gone from, they've almost been cut by 50% since April this year. The next thing I want to just show you is, again, forward earnings estimates, and I've zeroed in on technology and communication. In the first quarter of this year, people were talking about 22% in technology, but it's dropping down to, just half that in this quarter, and then even lower going into 2022. So the basic message here is that to the extent that people have bid up multiples because they believe earnings growth is going to be more rapid, now earnings estimates from the people who really have a lot at stake here, the big investment houses, are saying that earnings are actually going to be slowing. And that's led to a scenario that I think it was Bloomberg said it's like a Tarantino scenario. Here's the guys from Pulp Fiction, and what they were saying basically, what they were saying basically is that while the stock market has been rising overall, while the party's been going on in the front of the building, in the back, these guys have been taking out some of the high flyers, and they've been basically executing them. And that's what's been happening to some of these stocks. Here's a chart I put together showing the blue line, the mountain, is a quality growth fund, which basically is a proxy for quality companies, the ones that return good cash flows, the things that I like, that have good, robust earnings that don't tend to vary a lot. But look at some of the ones that the guys have taken out back and shot. Robinhood, Peloton, DocuSign, PayPal, Teladoc, Roku, all of them. I mean, some of them just absolutely being crushed, in the last couple of months. And the drop picked up considerably at the beginning of November, but, it's slaughter out there. And what that's telling me is that there's just no justification for buying these companies right now, unless you can get them at the lowest possible dip in other words, when their multiples get reasonable, sure, maybe, but they're not reasonable yet. You still have some way down to go. But there's a couple of other things, and I just wanted to mention them. You mentioned, Omicron and all that. What Chairman Powell is saying is that, this could lead to higher inflation because of the supply side, right? If China, for example, keeps trying to shut down their entire economy, if Omicron gets loose in there, then that's going to mean we're going to have supply side constraints. We're going to have more shortages, and that means that people are going to bid up the prices of goods, and we'll have inflation. But that means if the Fed tightens to try to contain that, that means we're going to get a downturn, right? Because you're tightening not because the economy is necessarily growing too fast, but because we just can't get the stuff. And that's a guarantee, in other words, to, it's, some people would call it a policy mistake, but, right now with inflation as it is, I don't think they have much choice. So in those situations, what investors want is cash flow. Just one last chart just to show that, expectations of growth if the Fed does tighten. This is what's happened to the oil price, which is a good proxy for expectations of growth. Just fell off a cliff, basically a couple of weeks ago. And that's going to feed through to make consumers happier. But I think it's an indication that markets think that the global economy is going to slow. Last point, a lot of today's retail investors are leveraged, and they have no experience of what happens when the Fed tries to tighten to control inflation. Never seen it. They were in diapers when the Fed did this before. And the best evidence of this is that right now, the average retail investor has just 46 cents in equity in their trading accounts for every dollar of margin balance that they hold. That's the worst that it's been since the dot-com bubble. In the old days, experienced investors would have listened to what the Fed was signaling and said, well, I'm going to dial that back in anticipation. They haven't done that. In fact, they've piled into the options market in an insane way. Like, I mean, I think I forget the multiple, but trading in Tesla options, call options, is something like 5 times the volume of trading in the S&P 500. This is basically a party where investors, they've never been to a party like this before, and they're not sure how it can end. Now, I'm not suggesting it's going to end, in a disaster, but better safe than sorry.
Now, Clint, I want to ask you. So I know before these things happen, there's always things that we can sort of look out for. So are there any indications, any charts we can look at, any clues we can sort of take in to know if the growth outlook is going to hold up or if it's going to deteriorate?
Yeah, there's several kind of market-based indicators that I would follow, that I would point out, because it just goes back to Ted's point about where the state of valuations and to justify where they are. I mean, companies, indexes, whatever, I mean, it needs to grow into those valuations. And so, that's where this, so far, this pullback can start to get worse, as if that growth scare starts to worsen. So what I want to look at is areas of the market, especially looking outside of stocks. Stocks are incredibly volatile, a lot of ups and downs. It can be very emotional. And so I want to look at areas that fall outside the stock market, but that are still leveraged to sort of that outlook for growth. So one area, probably the most important area that I'm watching right now personally, is with high yield spreads. So high yield investors, they're lending money to these lower quality, financially struggling companies. That's why they have to borrow at higher rates. And so high yield investors, junk bonds, whatever you want to call them, they're extremely sensitive to the prospect of getting their money back. And when they see those prospects dimming, that's when they start to demand more compensation to lend. And so that's really what a spread is. It's how much of additional compensation above a risk-free asset like a treasury that high yield investors are demanding. So I want to show one chart just as an example of this. A growth scare that we had back actually in 2018. This was the last time that the Fed was starting to tighten. We saw a bear market in stocks. The S&P fell just shy of 20%. But here's what double B bonds, so that's kind of the first tranche of high yield. Here's what that looked like back then. And so what I'm highlighting with the red line on here, when we climbed above sort of that 2.6% level, that's when you really start to see the growth scare kind of kick in. And that's when you really start to see the volatility and the downside pick up in stocks. And so what does this spread look like today? That's the next chart I have on here. This is that same spread, just looking back over the past year. And so here's what's different with this pullback that we've seen so far relative to the others so far in 2021. This line had continued to stay pretty contained. I mean, you had some bump ups every now and then, but no meaningful jump. But this time around, what I'm circling on red on here, we're starting to break above some key levels. So we're at that 2.5% level right now. This is one thing that I'm watching, that if this starts to jump higher, that tells me that growth scare looking forward is starting to intensify. Now, a couple other areas that I would look at as well, Ted flagged oil. I would definitely watch commodity markets right here. Here's a chart of the S&P GSCI index. This is a broad-based index of commodities. And, we've seen the dip, absolutely. But I mean, just look at this, look at the uptrend that we've had over the last over a year now. So right now, what I would watch with this index, it's pulled back to the green line on here. That's the 200-day moving average. For me to signal this as sort of a red flag for the growth outlook, as if we were to break below that 200-day moving average and start to take out some key price levels on here, like the 500 level. Now, one thing I would point out when using an index like this is that oil does usually feature pretty prominently. It tends to be a heavy weight in a lot of these indexes, and oil can be manipulated, whether it's through cartels like OPEC. Or the U.S. releasing, some of its strategic reserve. So one of the things I like to look at in the commodity space are metals, especially metals that sort of have a broad industrial use across many end markets. And so I would look at copper to that end. So here's a chart of the CPER ETF that tracks copper going back over a year now. And so far, this is not flagging the growth scare to me. Copper's been trading in sort of this range that I'm highlighting with a box on here since May or June timeframe. If we were to start to break down below this box, that would be my warning signal for a growth scare being reflected in copper prices. And then the last metric I want to point out is with inflation expectations. So the growth outlook heavily influences what investors are expecting for inflation. We can track those expectations with something called inflation break-evens. It's pretty simple. You can take a normal 5-year Treasury security and then take one that's indexed to inflation, a TIP security. And the difference between the two should be sort of your implied expectation for what inflation looks like over the next 5 years. And so here's that rate. Going back, I took this back to 2018 because I want to show a couple other growth scares on here. So the first red line on the left, that's in 2018 when we had that growth scare, and then you had the big dip in 2020 as well. This has absolutely shot higher since then. We peaked out around the 3% level, and we've pulled back some. We've retraced just a little bit of that. What I would look for on here is if we started to dip back below that sort of 2.5% level that we saw earlier in this year, that would tell me that the growth concerns are starting to intensify. That's weighing on the inflation outlook. These are the things that I would track, to see if that deteriorating outlook is really going to start to hammer stock prices here.
Well, it looks like this uncertainty isn't probably going anywhere anytime soon. But obviously, it's impossible to time the markets, and the solution is never going to be to just completely get out of the game. So let me ask you, what sort of companies might you look for in this sort of scenario?
Well, I mean, I've been saying all year that really the critical thing is, well, at least since the summer, is saying that, you want to look for quality. And quality basically just means companies that where that there's going to be earnings, and there's going to be relatively stable earnings. Those are companies that, are established, they have moats, they have a strong market position. There's no doubt that no matter what happens, they're going to survive. And just to prove that, here's a chart that I put together showing FQual, which is the Fidelity Quality Factor ETF, going back to the beginning of this year compared to IWO, which is the Russell 2000 growth ETF. In other words, the small cap growth stocks, and then ARKK, poor old Kathy Woods. Everybody's been picking on her, but this is why they've been picking on her, because you can say that the future is bright, and it remains bright, but right now, if you want to keep your money and grow it, you want to, all year you've wanted to put your money into quality. And it's true that if you already hold some of these stocks, you don't necessarily want to sell them and lose all your money. But it's going to take a while for them to bounce back, and you just need to accept that. And so if you want to rebalance your portfolio, get back into quality. Now, if you go to a place like Yahoo Finance or Seeking Alpha, and you look at the holdings for FQual, it's not going to surprise you. They're the companies that everybody would think in terms of quality. They're established, they have earnings, those earnings are not going anywhere. It's where you want to be.
Yeah, along the same lines too, you can look at LVHD. I'll show a chart right here. This is the Legg Mason it's a low quality, high dividend ETF, or low volatility, not low quality, low volatility, high dividend ETF. And similar to what Ted was talking about, I mean, this is one that goes through, looks for companies that have low volatility in terms of both their stock prices, but also low volatility with their earnings. So that means they have stable earnings. Historically, it's about a 2.7% dividend yield. You can see on the chart here, this is also held up better, as you would expect, than the overall markets during the recent pullback that we've had. And then, yeah, same thing. I mean, you can look at this ETF, but then go look at the holdings and see what types of companies are in here. I mean, you'll see that these are, that tend to be some staple names, or names that have sort of that moat or dominate their end market, and so they have that more stable earnings profile.
And as a final option, of course, you could always join the Bauman Letter, because Ted, I know you've made a number of recommendations, these last few months, this last year, companies that can withstand this sort of uncertainty. So.
Well, yeah, and just on that score, I mean, I just want to, at the beginning of the year, it wasn't clear where things were going to go, and we've had a couple of stocks just like everybody else that were flying high. We did tell people to take profits on them at the time, but they've fallen since then, and that's just the way things work, and they are clustered in that growth, future earnings scenario. But all this year, we've been just going over and over again, looking back at companies that have definite prospects, and that means definitely making money no matter what happens. And one of the big things, obviously, is infrastructure. So keep your eye on that. We got news on that score.
So make sure you click the link above so you can get all those details. Clint and Ted, thank you very much. Thank you all for watching. Please leave us comments. Let us know what you think, and we'll see you next week.